We're live from the Capital Club Dubai, which is a premier business club based in the heart of DIFC Dubai. Today morning, we are gathering here for a very, very important panel on green bonds and unlocking climate capital for climate solutions. My name is Akshay Arora. I'm from Euphoria Capital Partners. We are based in Dubai and Singapore. We are an investment company investing primarily into growth stage companies. Uh, we have personally made a shift as of last year, looking at more green projects as the world comes live to the reality that there's a huge amount of capital required. And how do we really identify green projects? How do we measure the impact and really mobilize the capital? So, just to set the context, this particular panel is really important because uh, we thought that the key to understand this entire mobilization is to really look at what are the financial instruments which would actually help us reach our net zero goals. The focus is on green bonds today. The focus is also on financial instruments which organizations and businesses seek to gain further access to the capital. We've got two very large corporates who will discuss about their journey in mobilizing green finance. We've also got a bank, a leading bank from the region, look at their view and how do they make economic sense of such investments. Without further ado, I think I'll really introduce our expert panel. I'll give a detailed introduction because they deserve that. They've been they've taken their time on a busy day, busy Wednesday to be here with us. We've got Yusra El Sayed. She is the Director for Sustainable Finance and Investment Banking within Mashreq Bank, which is a leading bank in the Middle East. Prior to this, she's been with EBRD, which is European Bank for Reconstruction and Development. She was with EBRD for about 10 years, looking at, again, investment banking. She's been at the forefront of policy development and designing investment projects. Would love to hear her view today on how she's been able to spearhead mobilizing capital. We've got Nalin with us. Nalin is the CFO of Yellow Door Energy. Many of us know that Yellow Door is a leading sustainable energy partner for some of the largest organizations when it comes to commercial and industrial assets in the region. They've been solarizing the region, MENA region and beyond. Nalin is from finance background. He heads the entire finance strategy. Nalin has about 30 years of experience. I think he's mobilized more than $40 billion. Great experience in terms of understanding how capital works, not just in this part of the world, but globally. And he's been also leading the fundraising efforts. So Yellow Door has considerably raised huge amount of capital in their growth journey so far. We feel that Nalin would be adding a lot of perspective in showing us how an organization can raise capital, what are the challenges and the opportunities here. We've got Carlin Naidu, who's the director within this group sustainability of DP World. We all know DP World, right? And DP World has been in the news lately, and Carlin had been directly involved in the issuance of the inaugural Sukuk, the green bond, which is in focus as a financial instrument. Green bonds in general have been on the rise, and Carlin will throw some light on what was the journey for DP World like. With that said, I think, Carlin, let's begin with you. Uh, Let us, understand. We've looked at the kind of capital we are talking about, right? So many organizations, nations, countries, including UAE, have set their net zero goals. By some means, as per Bloomberg lately, we see that $200 trillion of capital is required, to mobilize that kind of scale of capital. Uh, it's not easy, right? And many organizations are looking at various instruments. DP World has shown its commitment by issuing a green bond. Let's understand from Carlin, what is a green bond? Maybe most of you from the finance background might understand. But for rest of the audience, maybe something on that and what was the journey for DP World like, uh, so that you enlighten the audience on, what's it all about. Yeah.
Sure. Maybe before I go into the green bond itself specifically, I think often you hear these figures being touted around about how much of investment is required, to transition to net zero. I think that is an ongoing discussion, and the figures vary. However, I think the consistent message coming out of that is the fact that there are trillions of dollars of investment required for this net zero transition. So whoever you're looking at, the consensus is that there is a significant amount. I think one of the things that you'll find, however, is that up until 2030, and I'm speaking more from an industry perspective here, a lot of that investment is really going into renewable energy and clean technology. This is existing technology that's out there in the market, where the pricing has become to a point where it is practical, it's economical, it's feasible for those types of investment. I think going forward, what you'll see, post 2030, is a lot of new technologies that are coming out into the space. And we were just having a discussion earlier about some of the tech that we're looking at. And these are things that, unfortunately, these breakthrough initiatives, innovations, technologies require significant amounts of capital. And for, when we look at it, the challenge is twofold. You've got the financial the investors on one side, and you've got the industry players on the other side. I think I'll leave a lot of the finance stuff to my colleagues around the table here, but with this type of innovative technology, definitely there are significant requirements for looking at financing very differently. What are the different types of blended financing mechanisms available to make the risk profile a lot of these investments more practical? From a business model perspective, companies need to really change the way that they look at how they account for the project financing and cash flows, because this is new tech, which is, there's a lot of issues around supply and demand. And within our own industry itself, we're seeing that in shipping. There's various buyers alliances that are being evolved at this stage to allow for forward procurement of new tech, so that it makes a bit more sense for industry players to get involved. I think the other point here from an investor perspective is also around policy signals. What are the signals out there from a regulatory perspective? What are the incentives? What are the rebates for you as an organization to actually evolve into this journey? I think for us, when we look at it specifically as an industry player, we are in a hard-to-abate sector. When we look at our Scope 1 and Scope 2 emissions currently, at least 60% of those emissions are coming from our marine services division, which, as you all know, shipping is it accounts for at least 3% of global GHG emissions today. And there's a lot of difficulties in that space for organizations. There's a lot of challenges, and there's a lot of barriers. I think one of the big issues that we're seeing, or challenges that not just ourselves, but the industry is facing at the moment, is just the journey into alternative fuels. And what are the fuels available out there? There's a lot of fuels now: hydrogen, ammonia, methanol. No one is coming out as a clear front runner, but one of the fuels that everyone is looking at is green methanol. Today, if you look at the supply of green methanol in the industry, it accounts for at least 1% of what's required by 2050. That is a significant challenge for the industry. So there's a lot of investments that are required off the back of that. I spoke about business models. One of the things that we're also seeing, I guess, from an industry perspective, is just around the demand for green shipping. We currently, when it comes to building a ship, that's a significant capex requirement. There's a lot of build time that's involved in that. And once you make the investment, I'm sure there's a long lifespan for a lot of this capex that you're investing. So that becomes a challenge. Unless you have the supply signals on one side, you're not, most organizations will not be able to invest and make those significant capex requirements. I think, when we look at all of that, these are kind of some of the things, of the factors that we considered when we did our green issuance. So when we went to the market last year in September, we developed a sustainable financing framework, which gave us a bit more flexibility. I think, you normally say use of proceeds framework, you see sustainability linked. From the port sector, you generally don't see something that brings both together. So we had a combined use of proceeds, as well as a sustainability linked framework. So I think that was one of the positive aspects of that framework. Under our use of proceeds, so we eventually issued a $1.5 billion 10-year green sukuk. And the proceeds of that investment were really for the investments that we have made in our business. So it was to finance and refinance existing assets. At the time of issuance, we had a significant portfolio of assets because we've invested significantly in the business, to drive this green transition. A lot of the assets that we looked at, or the majority of the assets in our portfolio at the time of the issuance were mostly around clean transportation. So we had a lot of electrified equipment that was sitting in there. We've invested significantly over the years on that, and I'll touch on that a bit briefly later. And then we also had quite a significant component of green buildings. So we have a global operation. We have buildings in Europe, in the Americas, in Asia, and everything is against different certifications. I think you were asking about the sukuk itself. We very much tried to ensure that we had it as open as much as possible to the various investors out there. So you have the EU taxonomy. Our framework itself is not aligned to the EU taxonomy. However, there are certain elements around the use of proceeds that we try to align to the EU technical screening criteria. So there were very technical bits that we could at least say to a European investor, it meets these requirements. I think when we issued, we were very positive about the fact that the sukuk was certainly oversubscribed. It was 2.3 times oversubscribed at that time. And today it's listed on both NASDAQ and LSE. And I think you'll probably talk about this as well when it comes to the pricing. But this was one of the tightest
I'll also
prices.
come back to the proceeds because we want to understand how a corporate would use it to refinance its assets and maybe look at elsewhere globally for further investments into green technologies. I'll also want to understand from Yusra, because Yusra heads the sustainable finance for Mashreq Bank, which we know that Mashreq had during the COP28 last year also announced their sustainable finance strategy, and she's been driving that as well. Yusra, if you could throw some light on what is Mashreq's sustainable finance strategy, give us some idea on what are the core things that you do in the day, and how do you really see the end impact of Mashreq doing this in the first place?
Thank you for that. As you said, as a leading regional bank, and not just Mashreq, by the way, because it is obviously all of the local and regional banks here, we've all committed during COP28 at deploying up to, $1 trillion dirhams by 2030, because we see the need, we see that we need to lead the way for the regional investors, for the local investors to feel, the need to deploy this capital, this much capital. And thank you very much for saying that. I think the idea here is that, and echoing what you're saying really is, we're looking at rewiring the economy, right? It's a whole rewiring of the economy that we're trying to do. We know that we cannot keep on doing what we used to keep on doing. Things need to change in a way to just have sustainability at the forefront and at the end of it. We are trying to reach impact. We are trying to scale up whatever is needed. You're saying a lot on the renewable side, which is definitely much needed and everything. But the way we see it as well, we're moving from adaptation to mitigation as well. Mitigation is becoming quite a crucial aspect to look at when it comes to sustainability, etc. So as a financier, we do play a major role in deploying the necessary capital. But with the tools that we have today in our hands, this is not necessarily the right tools in order for us to deploy the right capital. We need to have that dialogue, and we're having a lot of the dialogues with our counterparts, with the industry, with the authorities, with the governments, and all of the stakeholders in order to understand, because you hear me talk from a financier perspective, you hear him talk from an industry perspective. I pretty much think that we'll be aligning on everything we're saying, right? It's just a different perspective. We know that this is a multi-stakeholder approach. We know that this is an effort that needs to bring in the right regulatory framework, the right industry appetite, the right commercial incentives, etc., etc. So from Mashreq's side, when we say sustainable finance, sustainable finance is really financing projects and tools that have environmental impact, sustainable impact, etc. So it is a very wide definition of what sustainable finance is. The reality of it is we don't, every day find a green asset to finance and go ahead and provide it with the capital needed in the structure needed. It starts from, trying to understand how the decarbonization can happen, how transition can happen, who are the industry players that can lead the way for others to follow on. It's a lot of advisory, it's a lot of capacity building, it's a lot of,
Right.
so from a Mashri standpoint, we try to, as much as we can, accompany our clients to have this discussion. What are you challenging? How can we overcome them? Is it that you're not finding the right assets? Is it that you're not finding the right capital? Why are we, stuck? And how can we really move forward with innovative solutions, with innovative financial solutions? So you've talked, obviously the labeled products, the green
And,
bonds,
yeah.
etc.
And Yusra, do you, while evaluating and identifying a green asset, apart from the returns profile, do you really have a criteria set for, measuring the return or the return on, the impact that you actually create or the business is creating?
So two things. You talked about return and you talked about impact.
Yeah.
So, and we take both into consideration. From a risk assessment, sustainable finance considers much wider risks that are typically considered under, your standard
Traditional
conventional finance. We look at, I like to look at the 5 capital approach, right? What are my environmental risk? What is my social capital risk? What is my human capital risk? What is my nature capital risk, etc. And then once you see those, you need to try to mitigate them. So from a risk perspective and from a return perspective, if I'm seeing that the impact and not the impact, the returns are going to be not just on the financial capital, however, the returns are going to affect all of my 5 capitals or 6 capitals today, then, the appetite becomes a little bit different. From an impact perspective, and this is where, the market is moving forward, and I'm very happy to see colleagues from other banks whom we work very closely with in order, to streamline the dialogue and to align ourselves. Impact metrics are very difficult to assess, right? You don't have a blueprint of impact metrics that you can use for each and every, off-the-shelf type of solution. Impact measuring is a crucial thing for us, and we are trying to develop that. When I look at DP World, it's not the same way as when I look at Yellow Door. It's not the same way when I look at, a retailer or others. So on the impact, this is still work in progress.
Still evolving, yes. Everybody
Exactly,
agrees.
and very much evolving.
Thanks a lot for that. I'll come to Nalin and hear from him. So Nalin, Yellow Door is a classic example, like a financing side is different, but you have dealt with some of the global institutions while raising capital for Yellow Door, right? We'd like to understand what has been your go-to approach or go-to financial instrument. Uh, we've seen that you've got organizations on your cap table from IFC to Epicorp, some of the very well-known investors. Two things we'd like to understand, maybe. One is what was your go-to instrument? Second is how were you evaluated? Were you being funded from a sustainable finance corpus of that institution? Were you part of that strategy, or you would have looked things differently and you felt that you've been evaluated in a different way?
Sure, absolutely. Happy to. And just to echo what we've heard today, right? There are trillions required. Absolutely, there are trillions and trillions required. You're not going to be able to put your finger on exactly how much money is required for the just transition. And this money is not going to come just from public sources or just from private sources, right? There has to be a combination of both. There's got to be a PPP strategy, a public-private strategy, which we can talk about in a bit. But coming to Yellow Door, most importantly, you have to understand what we do, right? We provide renewable energy solutions to companies in the commercial and industrial sector. What does that mean? It means we build, own, finance, and operate solar power plants for companies in the commercial and industrial sector. In the GCC region, we're very big in Jordan, and we're in South Africa. So if you're a factory, if you're a mine, if you're a warehouse, if you're a mall, right, we will provide you with a solar solution, and we include in that something called BESS, battery energy storage, so we can provide power solutions that go almost 24 hours in the day. What does that mean for us, right? We enter into long-term PPAs with our customers. Those PPAs can go, a power purchase agreement, right? Those PPAs can go anywhere from 10 to 20 to 25 years. But we put all the investment in upfront. So we actually fund the development and the capex of the power plant. Heavy capital utilization up front, and you get your return over a period of time. So as a company, we are capital hungry, and as long as we continue to grow, which we plan to, for the foreseeable future, we're always going to be heavy users of capital. So then how do we fund ourselves? We fund ourselves with a combination of equity and a combination of debt, right? And we like to have a percentage that's more debt than equity because it helps us leverage our returns. So what happened about 2.5 years ago, 3 years ago, when we started our journey raising capital, most important thing was to say, okay, how much equity do we need? And how much debt are we going to need to fund ourselves for the next 5-6 years? You don't want to keep, a company like ours, you don't want to keep coming to the market to raise equity every year or two. Yeah. And that started a dialogue with investors that understand renewable, the renewable business, understand the just transition, because others would just not get it, right? And some said, why don't you raise 100 million now? We'll give you some now, let's test it out, let's see what happens. No, then we'd be distracted as a company. So long story short, we settled at the end of our process of discussing with investors with Actis, which is a London-based private equity investment company, right? Which is almost exclusively focused or heavily focused on the just transition, on providing equity financing to companies like Yellow Door that are involved in renewable energy solutions. We happen to be in solar. Actis invests across the spectrum, and we found Actis to be the best match, right, from our perspective, because they understood our business. They recognize that our payback periods take time, and more importantly, or as importantly, they've invested in other companies that look like us across the region and across the world, right? So the synergies are fantastic. Yeah. We not only just get money, but we also get a lot of know-how, right, and access to other companies. How did you do this? Not even scratching the surface of synergies on purchasing, right? Can you imagine how many panels are purchased?
The supply chain gets
across the system. Yeah, absolutely. So we were really lucky and happy to have gotten Actis in. They came in for a very large percentage. They bought into the company and took a controlling stake in our cap table. And I think what was testament to the company and to where we want to go in the future was Mitsui, IFC, and Apicorp, who were shareholders before Actis came in, wanted to stay in, right? So they stayed in, and once again, IFC needs no introduction. They are a very active player in renewable, in actually promoting renewable finance. Mitsui doesn't need any introduction either, because they're an extremely large investment house out of Japan, and Apicorp, in the region, is a powerhouse, right? And their stated mission is to work with companies like ours and provide us with financing as well. So it was very important for us to align the equity side of our balance sheet with investors that understand what solar is and understand the dynamics. Now, coming to the debt side, right? We had a decision: do we try and go and raise a bond, or what's the best way for us to proceed? And we decided at the time, because we're growing and we wanted to get to a certain critical mass, best to get bank financing, right? And get bank financing on a portfolio basis across each one of our countries. That made a lot of sense at the time. Remember, I'm also coming out of COVID, right, in 21, 22, where global liquidity was a bit of a question mark, but local liquidity was actually strong. And what we found was regional banks, be it in Jordan, be it in the UAE, be it in the Kingdom, Saudi Arabia, were actually, had liquidity, wanted to understand and invest in what we do. However, there was what I would call a period of mutual education, where we would have to talk to the bank and say, listen, this is what our business is, this is how it operates. We're not very different to a bank.
Yeah, okay.
We put a lot of money out up front. It's like making a loan, right? And then we get paid back over a long period of time. So we take a risk. We're in the risk business. It just so happens that rather than give someone money, we actually construct the product ourselves, right? So when banks started to understand our model, and we started to understand their limitations around risk, we started to find that middle ground where we were able to start borrowing.
Right.
More needs to be done. We do, as I said, we are voracious when it comes to consuming capital, right? We have the equity side.
We've got
locked in.
Yusra here,
Sorry?
hearing it very.
Looking for the checkbook. I don't see it, but you know,
she's got it.
I'm sure we'll figure something out at some point. But so that was our journey of how we funded ourselves to date. We're going to keep using various debt instruments going forward. We do, and I do have my eye on a green bond, right, in the future. We will refinance ourselves more at the top co as opposed to country by country. Will it be a
Right.
year, 2 years from now? I don't
No,
know.
that's great to hear because my next question is something on that area as well. So globally, we have looked at the green bonds market really heating up. It's very hot. We've seen last 2 years. So what it's called is GSSP, Green Social and Sustainability Linked Bonds, right? And the market globally is about $1 trillion by some estimate. But looking at this region, right, Middle East, we've just seen notable. We can count on fingers. There's PIF. So how it's like sovereign funds. I think PIF and Mubadala. Few banks have issued, sukuks, and likes of DP World. Uh, Collectively, give or take, it's about $24 billion as against what's happening globally. So China, US leading the way, of course. Uh, what do you think is the limiting factor, particularly from unlocking private capital and also corporates issuing green bonds? So the green bond market, where do you see the growth coming from? Any innovative financial instruments that you've come across? I think you also mentioned blue finance. I'd like to hear each one of your views, maybe starting with Colin. You could,
Yeah,
because you've been at one of the organizations who actually issued a sukuk,
Yeah.
and that's still 1.5 billion. PIF came with about a $3 billion green bond. So do you see that coming?
yeah. I mean,
Sure.
the industry, it's quite interesting because I think I've been in the region for some time. I was with the bank before I entered the industry. And you're definitely seeing a lot of traction in the sustainable financing space. I think there's a lot of positives and enablers that are coming out that are really driving the movement towards this. So you've got supportive regulations, you've got climate pledges that are being made, you've got targets that are out there, you've got reporting standards that require you to actually report on this, which also really drives and creates those driving forces that are required to shift into this space. I think obviously I mentioned we issued a green sukuk. Some of the things that we're looking at across the industry, across the region, areas that we see potentially in terms of interesting instruments that are available out there. Definitely, the sukuk, the green sukuk or the sukuk space is quite an interesting one. I think so far there's probably been about 47 billion of issuances in the sukuk space, sustainable sukuk space, with most of it coming actually from I would say UAE, KSA, and some out on the east side. I think one of the things that you'll see in sustainable sukuk is just the fact that there is that overlap and similarity with the existing standards out there. So, for any investors that are looking to issue in this, like a sustainable sukuk, you have access to additional pools of capital because the investors that generally will go for green and then sustainable are probably the same types of investors. I think another space that we're having a discussion about earlier is just there is only so much you can do on the green side. There is a limitation in terms of the assets that organizations can invest in. The technology is not there. There are certain challenges. Transition is really an interesting space that I'm personally, I've read quite a bit about it, and I think it's quite an interesting area, transition financing. It hasn't taken off that well. I think most of the issuances you would probably see are from your energy companies. But to Nalin's point earlier, around the just transition, this type of technology is really something in emerging markets, or this type of financing is really something that's useful in those types of places where green potentially may not be an option. However, the technology that they're investing in is significantly better than the technology they have today. So those elements are really positive. I think one of the challenges generally that you see in transition financing, however, is just a lack of clarity on definitions. And I think that generally when it comes to financing, that's always a difficult thing because you have companies that are willing to make the investments. You have banks on the other side, the investors on the other side, who need to understand what you're actually investing in for them to call it transition or for them to call it green. So, the taxonomies are extremely important. There have been a few developments recently, but again, that clarity is still somewhat lacking. I think ICMA came up with a climate transition financing update last year in 2023. You've got Singapore under MAS coming up with a ICMA taxonomy, a transition taxonomy where they look at what's considered green, what's considered orange, what's considered ineligible. The development of that, I think, is extremely important. We've just seen one of the banks, I think it was a couple of weeks back, where they came up with a document around how do you align mitigation and resilience. How do you ensure that these types of projects actually are becoming more eligible to the financiers. And I think that linkage is extremely important. Another space which is really interesting and again, extremely nascent is blue financing. But again, I think there was a guidance document that came out last year through ICMA again. But again, the granularity that you see within the green space is not there yet on the blue. You speak to anyone about blue could potentially be green could potentially be blue, which really creates a bit of difficulty for either the issuer or the banks on the other side. So I think those are potentially areas that are quite interesting.
No, definitely. I think what we are kind of seeing a bit of a sort of conclusive thing is that this gap between the financiers' understanding or maybe a charter where, for example, Nalin mentioned that they had to really educate, there was this educating phase to the financing institution that what their business is, right? Or why is it green and why this financing needs certain different evaluation criteria or payback periods. Nalin, maybe you could throw some more light. You mentioned that you're also going to add to the green bonds in future.
Yeah, look, we would love to issue a green bond for various reasons. But if you think about it, right, one is to get the green tick. Yeah. We are a green company in everything we do. Right. So we don't necessarily need that green tick. From my perspective, what I care about a lot is my cost of capital, right? The lower my cost of capital, more I can deploy, better return I can generate. By the way, this is very important for companies in the renewable space, the ability to generate returns for our shareholders otherwise and stakeholders. Otherwise, money is not going to flow into the renewable space as fast as it should. So the question I asked today is, what is, as the CFO of a company, what is the coupon uplift that I'm getting doing a green bond versus a regular bond versus a syndicated loan? And at various points in time when I've looked into it, the coupon uplift that I'm getting, i.e. the reduction in coupon, is a paltry few basis points on the green bond versus the other sources of capital. Yeah. But the cost of executing a green bond with all the
process
use of proceeds and the documentation and monitoring thereafter, right?
The trade-off doesn't fit in.
Trade-off doesn't quite, so that we need to work to ensure that trade-off exists, that you will get a good coupon. And coming back to what people have said, we do need more regulatory support. We need more pockets of capital, be it family offices, financial institutions, globally, right, to start to focus on renewable-based financing, right? And better transparency, taxonomy alignment, company of investors having to, in a very transparent way, report their green investment, right, which then forces them to go into a certain asset class. All of these things, they're happening, right? We shouldn't take away from the fact that they're happening. I almost feel like we are, 40, 50 years ago, we were in an industrial revolution of sorts. Yeah. We're in another revolution right now, right? And over the course of the last so many years, over the last 5 decades, we said minimal government, right? I think we now need a little more government, right? To ensure that we get these instruments more into the fore, right? We
Awesome.
create more of a
Yeah.
marketplace for them,
Correct.
right?
The marketplace is a good idea and some very valid points that whichever is a limiting factor and numbers work the most, the coupon uplift you mentioned, those are some nitty-gritties of, thinking through the entire transition and making green bonds more prevalent in the region. So, it does answer, what we're looking for. Yusra, I think now let's maybe shift the focus more towards how a banking institution really invests into a green tech company. You said it's not every day that we look at companies which kind of fit into the criteria. As against, we're also seeing the narrative that companies have to really explain why they fit in, right? So what has been
Absolutely.
or maybe give some examples, maybe on no-name basis, that this was an investment, how you looked at it, maybe some idea on the size of capital that you look at, so that and how can businesses really access that capital?
Happy to. However, I'd just like to say something. I mean, just
Sure,
back
sure.
quickly on the. I was thinking because the reality is that the greenium on the DCM side is very limited, right? And particularly in this region, as you said, you've been oversubscribed. However, we're seeing a lot of liquidity anyway. The only thing that we're seeing the difference, and maybe that does not concern you as a pure play company on the green side, what we're seeing for others is that the pool of liquidity is different. Those that would not have typically been looking at this region, this company, this world, those are investors who are very much attracted to the green tech, right? So while I appreciate that the liquidity is abundant in the region, however, the diversification of this liquidity might not be necessarily translating into a greenium because I mean,
Exactly.
that's very true. However, I mean, it depends, you know. I mean, there are instances. I mean, we've seen countries that are not of investment grade. However, issuing green issuances, I mean, in the MENA region, etc., they have attracted the right amount of, I mean, the just amount of liquidity for them to be able to issue. So there are many levers that needs to be used to properly unlock the potential of the market and, as you said, create this market. However, we're still on from our side on the DCM side. When we look at who's subscribing, why are we oversubscribed, the number of oversubscription, I mean the X's might not change, just the composition might
change.
just on the institutional side change just
Makes
a little
sense.
bit. So sorry. So that was just on
That's a
the.
valid point. Yeah. Yeah.
So from our side, again, on the financing side, the way we look at it, and as I said, it's very difficult to find every day a good opportunity or even a pure play just like Yellow, right? We need to make a distinction between, and as it has been said, between transition and green, right? It's very important to understand that we all need the just transition. It does not happen overnight. We're not going to wake up in a world that is fully powered by solar and with zero emissions everywhere. There needs to be a just transition, and when we say just, it does not only take climate change into consideration. However, it takes the social and wider environment into consideration. And that's why when we look at it from a Mashriq perspective, we look at it from a impact versus integration. Impact, these guys do impact, right? I mean, we have the right metrics to measure the impact that they're doing, the emissions reductions that they've achieved, et cetera, et cetera. Integration, and it goes back to your business integration. A lot of the big corporates are doing something, right? Everyone is on a journey. Why should I neglect those and not look into how can I support them from a sustainable finance perspective in order for them to achieve their transition? So those are two big buckets, right? Impact and integration. So for us on the integration side, the tool that we have seen that helps tremendously our client is sustainability linked loans.
Okay.
Because they are not necessarily a use of proceed or a labeled, bond or loan or etc. And they are incentivizing our clients to move in a certain direction without necessarily foregoing the needs to actually move the business forward, right? So while we definitely appreciate the use of proceeds, however, you will see that the non-use of proceeds type of sustainable finance, which is really the sustainability link, are quite important. And to give you an example on that, so we were looking at we just financed a company that is in a hard to abate sector.
That's ready to.
Hard to abate sector. So
Okay.
it was it's a steel manufacturer.
Yeah.
The need for the funding was not necessarily all green. I mean,
Right.
they did have some green capex that they needed to, but the reality is that they needed to grow the business as well. We couldn't disregard the fact that these guys, they also want to start decarbonizing. They also want to see how they can start their decarbonization journey, whether with the installation of renewable electricity, whether of, looking at alternative solutions on the electricity side. So we were in a situation where they want to do something, however, not all the money they require belongs to that bucket.
Yeah.
So that's why we worked with them in order to understand how we can make this a sustainability link. And sustainability linked, typically the way we look at it is it needs to be core, it needs to be ambitious, it needs to be very relevant to the sector, to the region. So we would work, for instance, with a DP World. They have some working capital needs, or I mean, longer term capital needs for business operation. However, we know that they want to decrease their scope 1 and scope 2. Why don't we work with them on setting those KPIs and those targets with them? The more they achieve, the better they are incentivized to even do better. And at the same time, we're not halting their business operation, right? So it needs to be a just equilibrium between what needs to be done and how it should be done.
Right. So, Yusra, just two questions related to that. You mentioned sustainability-linked loans. Typically, a sustainability-linked loan evaluation criteria and from conventional finance, is there incentive? Are the coupon rates less, or the cost of capital? How does it impact? Do you really look at it differently? You've been in the investment banking career all along. You've seen various projects, so maybe now organizations who seek access to finance, which is green capital, do look at some difference. They want to be viewed with a different lens. So if you could highlight some figures.
So, again, as a commercial financial institution, we do not provide subsidy on our loans, right? We do not have access to blended finance. We do not have access to subsidized finance. However, what is happening is that we're looking at risk from a different perspective. Environmental risk is now embedded into our criteria and into our considerations. So when I see that you will be achieving or that you will be mitigating one of those risks, by virtue of how it works, your credit profile will be enhanced, right? So the pricing that is associated with that particular investment or with that particular company will be enhanced. So the idea is really a risk, taking into consideration the right risks, mitigating them, and thus enhancing the credit profile. So whether we subsidize green loans or green or sustainability link, we do not. However, I will give you that extra reduction on your margin if and when you reduce what I see and what I foresee as a risk for me. When you reduce that risk, you will be compensated on your margin side. So that's how it works. It's not we're not a charity at the end of the day, right? And it shouldn't be, as you said. If the capital is not flowing correctly and the returns are not being made, nobody's going to touch it.
100%. I think Nalin mentioned that it's very important for green companies to also look at providing the right return to the shareholders. That is why it makes it more commercially viable as well. Great. So, Colin, coming back to you, right? DP World has been integrating sustainability overall in their business, and green bonds kind of support that vision. You mentioned proceeds. Like Yusra mentioned, the kind of companies they would go out, the sustainability linked bonds. But for DP World, the proceeds for the green bond for the Sukuk, is it all being done internally, the proceeds, or are you also looking at investments outside? And what is your evaluation criteria, or the region of focus or the sector of focus?
I mean, just to build on what Yusra was saying, I think because we know that sustainability linked is an option, we did build that into our framework just to give us that flexibility, not necessarily to issue against that. On the use of proceeds is essentially our own capex, what we've invested in as an organization. So we did a scanning across our various business units across the globe to identify these specific investments. And again, because the green taxonomy or the green requirements are so clear, I know that there's certain assets that we have invested in that can clearly be linked to green. So I can say that if I'm investing in a specific crane in a port, that crane is zero emissions because it's zero tailpipe emissions, so it meets a very clear criteria. So a lot of those investments were our own. Or actually, all those investments are our own. We do look at other innovations out there, but that's not specific. That's not part of our core day-to-day business. We do through various partnerships, strategic partnerships, grants, etc. We do look at innovation technologies out there, and we do evaluate that, but trying to understand that specific to our own business. I think obviously on the bank side, you look at environmental and social risks when you make investments. As an organization, we also, when we're looking at projects, we also have integrated environmental and social risk management into our processes as well. So we ensure that when we're making investments, or when we are looking at a new plant, a port, or a new facility, etc., these are considerations that we always look at. Are the environmental aspects being considered? Is it aligned with specific performance standards out there which are applicable to us? Are the social aspects being met? If yes, then those are things that we integrate within our projects as well.
Right. So the evaluation criteria within the group's businesses is pretty much same to look at an overall aspect of whether this could be funded at the moment or not with this group.
So ours is not so much the funding, it's how do we mitigate the risks involved with that. Yeah.
Perfect. Nalin, just a quick one to understand from your perspective. We've heard, how green finance will go in the future, but let's say if you were to still go out, you said you would be capital hungry when you're growing. Do you see the pace of conversations for access to green finance faster now? Or would you say that you still want to hold back and because of your capital needs, you would want to keep on the conventional conversations going on?
No, certainly. Look, from where we were just a few years ago to today, conversation around what I would call green or renewable or somewhat subsidized finance, those dialogues in the region are actually increasing. So I am very, very positively predisposed to continuing to go down that path. We're getting multilateral agencies, lenders in this region, in the UAE, in Saudi Arabia, talking to us saying, listen, let's work together, right? And we're certainly putting our brains to this, maybe bring them and commercial banks together, maybe start to do multi-tranche facilities, right? So you get some sort of blended finance, right? We're also working very closely, to your point, with providers of credit insurance, right? So that we can enhance our credit profile, right? So there's a reality of here and now. I need to fund myself, right? So I'm funding from wherever I can get decent funding, but we're putting a lot of time and effort into sustainability linked financing, and I'm using the term very broadly, and we're going to continue to, and I won't say surprised, but I'm actually quite encouraged by the level of dialogue that we're having across the region. The interaction is actually
100%.
good.
I think organizations like you should be rather at the forefront of seeking out capital and making the conversations faster, because once something like this happens, it'll be out in the news, and it kind of helps the industry overall.
There's financial engineering and innovation required, right? And it's only going to come from all of us that keep trying new things.
All stakeholders involved. Yeah. Right. 100%. Great. I think we've touched upon various aspects of, what both sides of the industry look like. Maybe to conclude, I would also want to briefly touch upon the role of government, and somewhere we heard the regulatory aspect being talked about. I personally feel that that's again a gray area. Maybe those involved within also understand the regulatory aspect, but what are the specific things from a regulatory standpoint, incentivization standpoint? Maybe 1 point each, if you could mention on that. And secondly, in terms of your view, particularly Yusra, how would you say that businesses could have more visibility? How financial institutions are able to fund green projects? I mean, we've got a couple of bankers in the room as well, who obviously have targets of pushing across sustainable financing. So it'll be good to understand that part as well. So regulatory and maybe the access to finance. And this would be the concluding remarks from each one of you.
Yeah, maybe just on the regulation side, I guess we are working in an industry which is becoming quite regulated when it comes to emissions, especially because we have significant operations across the globe, specifically in Europe. So there are positive regulations out there which are forcing organizations to actually reduce their emissions from their own operations. I think definitely we're seeing that already. Emerging European regulations, which will impact us. I think the one thing that I find, because it's an area which I focus on very specifically, is around the reporting side.
Yeah.
Because we are, because we have operations in multiple markets, and you have regulations coming out of Europe, for example, the CSRD, which does impact us because we have subsidiaries that are operating there. The regulations by default are forcing organizations to be able to better understand their footprint, better report on it, better disclose on it, be much more transparent, because eventually over time these will be audited to the same extent that your financials are. So I think these are specific considerations at the back of our heads. We're trying to understand what are the requirements. When it comes to CapEx, I think, or OpEx, a lot of times you hear people talking about, oh, we've invested, we've done this. The requirements through the new regulations are actually show the numbers, show me your green balance sheet, show me your green income statement. It's becoming more onerous. So I think, that I see as an extremely positive development from a reporting perspective, which forces organizational change. Yeah. I think, what was your second point around?
Access to finance for businesses in general. And maybe I'll just plug in the final yes or no question. Do you think if the number is $200 trillion by 2050, do you think we'll achieve that?
Me.
I said we. Do you think organizations like yours and globally?
I think
do you
everyone's
we're the right
making,
place?
I think most organizations are definitely making the most amount of effort that's available with the existing technology, with the existing capabilities out there. I think, very often we get quite blinkered with the 200 trillion or whatever the value is. It's not just also, I think, very important, and Nalin brought this up, Yusra mentioned it, it's not just only about decarbonization. There's other aspects that you need to focus on.
Social,
So the social aspects are extremely important. We've just done a piece of work now where we've defined a sustainable development impact disclosure. So that actually starts linking back the investments that we're making in emerging markets to the SDGs. So in a specific market, I can tell you very clearly which is aligned with what investors are looking for, how my investments are helping to support access to water, access to education, providing increasing gender equality in organizations. So I think it's not just the 200. I think there's a bigger even number on the just transition side.
Yeah, perfect.
Oh boy, can't limit to just one. But look, I think overall, what I would say is that governments, regulators, they need to work to stimulate demand in green investment, right? And you can do it in various ways. Enhanced disclosure, grid stability, phasing out energy subsidies, right? So that people like us become more competitive, removing regulatory caps, creating a marketplace, creating an exchange for securities, right? So building on liquidity. These are all measures that regulators and governments are doing across the world and need to continue to do. As I said, to pull in private capital. Both sides are needed for us to get to this 200, 300, whatever the trillion number is going to be in the future. Does that money exist in the world? Will it exist going forward? That money absolutely exists. We just have to find a way to harness it, and that's where governments come in to help us. Multilaterals come in.
No, definitely. I think, yes, so the whole agenda was to understand from you in terms of how this mobilization works. So it could be any number. Yusra, final comments from you. The goal is $250 billion across UAE. There are pledges around. What do you see as the regulatory aspect? How are banks kind of involved in this as well?
So, as you said, it's carrot and stick, right? I mean, it can only work as a carrot and stick. The carrot should be subsidies, should be support proper PPPs being established, etc. The stick, we need to understand that once you start pricing negative externalities, then everything else will make sense, right? For as long as fossil fuel is more expensive, no one is going to touch renewables. I mean, unless you start pricing the negative externalities and the price starts adjusting, and then it would make sense. That's the role of the regulator, is to understand when to use the carrot, when to use the stick. It's, you know, it's a combination of both, as you said. And again, it's not just onerous on the government and the reform side, it's onerous on all of us.
Private
This is a
capitalists,
multi-stakeholder approach, right? I mean, the government can do what they can, but if the private industries do not start as well seeking opportunities and pushing the boundaries, nothing is going to change. If the financiers are not willing to, you know, wet their feet in a little bit different and innovative solutions, no one is going to be able to scale up to that to the amounts that are required. So everyone has a role to play. Everyone has a lever to unlock it. So
Yeah. No, great. Thanks a lot for that. I'm really happy to hear all the views and pretty expert opinions. I think a few points are really valid in stitching off this journey towards net zero. We'll leave the floor open to any questions. Anybody who'd like to ask specific things to our expert panel. Happy to take a few questions. Yeah, please.
Thank you so much, Ali, for this very inspiring session and informative. I want to ask you, about the Yellow Door. You mentioned the appetite from investors on those.
And there was-
The appetite for the investors are increasing. Do you find that to be the case here regionally in the GCC or globally? Do you see difference? And another question for the PPPs, what's the investment horizon? I mean, the lockup, it's pretty long, I'm assuming. So if you could elaborate on that as well, I would appreciate it.
Sure. So two answers to the question. The first one, are we seeing appetite increase? Absolutely, globally, right? The West led in the past, the Chinese caught up, right? And they've quadrupled their investment, right, in green energy. And certainly in the region, in the GCC, we found that dialogue is increasing and our access to more sustainable financing is increasing. So we are very encouraged by that. There's no question. And you know what happens to these types of discussions is the way they scale up is it takes a long time for a discussion to happen, but then when you start accessing capital, right, the rate of change increases big time, right? And you start seeing real tangible growth. So that's what we're expecting to happen over the next 3 to 4 to 5 years, certainly in this part of the world. And we're seeing, you know, PPP come together here as well. It has in the West, it has in Europe, it has in the US. We certainly see it happening more here, and we see it happening more in Europe as well, right? It absolutely has to. So we're encouraged, be it multilateral organizations. So you've got, you know, the IFC and the World Bank certainly have a very global and a very emerging market focused plan to push renewable energy based financing, right? We're seeing local governments here do the same, right? We're in dialogue with multilateral agencies that are domestic to the UAE, to Saudi Arabia, etc., that are in very similar discussions with us. And I think that's where COP28 here certainly helped, right? Because it started that dialogue. At the end of the day, it's really dialogue, and a lot of what we're doing here that helps push. There was a second part of your question as well, right? Which
PPA's time frame.
The lockup.
So look, as I said, our PPAs are very long-term in nature, right? Now, the equity that we have, you know, is long-term. It can be as long as we need it to be. Obviously, we've got financial investors backing us, so there will be some sort of an exit at some point in the future, but we're in no rush for that. When it comes to debt, we're seeing tenors all the way from 5 to 15 years. So in South Africa, for example, where there's a lot of liquidity and what I would say is a very strong understanding of the renewable sector, we're seeing tenors well in excess of 10 years, right, for debt. Now, that certainly helps us. Do I actually expect any of these loans to be outstanding for 10 years? No. We will refinance them in time, right? We will be more efficient with our capital structure, but we are getting, 5 to 7 to 10 to 15-year tenor, right, when it comes to our instruments in across regions.
Thank you.
Thanks, Nalin. Any other questions? I think we have from the back.
Thank you for that, guys. I guess what I wanted to ask is I obviously see how companies like Yellow Door offer leapfrogging solutions from an energy perspective to emerging market economies. But I think that if you look at DP World's operations and its solutions from an infrastructure perspective, there's probably an argument to be made that we offer leapfrogging solutions to our emerging market partners from an infrastructure perspective, whether that be greening infrastructure in the form of ports and terminals or other infrastructure within the trade value chain. And so I guess my question is to the commercial banker in the room is, apart from things like the Sustainable Development Impact Disclosure, what other ways in which can we, I guess, prove to you that the finance that we're looking for will be used for sustainable
So that's the thing, and that's when we started discussing that impact is not streamlined yet, right? I mean, it's still very difficult, and this is what we're trying to. I mean, there are the metrics that are acknowledged, like the harmonized metrics, of the NDBs, etc., not necessarily being used on the commercial side. However, that's why we need to work with you. I mean, that's the kind of dialogue. I mean, my question, I'm returning it to you. How can we do that? That's exactly what we're trying to figure out. The right taxonomies, the right, blueprints that we can use from elsewhere. Definitely, that's what we need. But
I think calls for some meetings outside the room now.
absolutely.
No
We've
question.
generated enough conversations so far today, I guess. Any more questions? Maybe we'll take one last one.
There's a question on LinkedIn.
Great.
Component. DP World is factoring environmental and social risk assessment within their framework. Where is DP World on incorporating the climate risk assessments on major projects?
I think when it comes to, okay, so firstly on the climate side, I think we have quite a mature decarbonization strategy across the group. So we can look at our data almost granular at a specific site. However, at a group level, we do have specific targets. We've just recently updated our targets actually at the moment. We've got more aggressive targets on scope 1, scope 2. We have targets on scope 3 as well, which we've just recently introduced. I think we're one of the few organizations in the region to actually get our carbon emissions actually assured by third parties. So, on that, we have a very clear targets. We have very clear governance around how we manage our decarbonization program. We have a lot of initiatives across the group which are really aligned to that decarbonization program and have helped us to reduce our emissions. We report on this, extensively within our sustainability report. We're also one of, I would say, we do TCFD reporting. So we actually have quite a granular level of data. I would suggest having a look at the sustainability report because a lot of that information is actually captured within that reporting.
Sure. I think you want to ask? Okay. Maybe he wanted to ask initially.
Yeah. So again, this was a question to you, Yasmin. I'm just trying to paraphrase what you said in terms of the final comments. One was that there's a general paucity of leadership, which obviously leads to less conversations happening here. The second thing that you mentioned out here was that there is a general appetite of investors not interested in this side of things at the moment. And I hope that's going to change in time. The third thing that you mentioned essentially, which you alluded once again to the gentleman's question, was regarding standardization to taxonomy, which obviously will need some adoption. So my question to you is that you have a pretty lofty target to achieve in a short term. Are you looking as a bank to invest in deals which are outside of the region, or are you limited like any other development bank that you're going to only focus on deals within the region?
So the reality is we work in our regions of operation, right? I mean, that's the reality of it. I mean, we at the end of the day, as a commercial financial institution, we have a footprint, a regional footprint. However, does not mean that we're not eager to explore. If opportunity comes and makes sense, we will always be looking at ways on how to approach it. Might not be a clear yes, might not be a clear no, but definitely we have very open doors when it comes to looking at opportunities that are innovative, that could push the boundaries from our side, and that would make commercial sense, obviously. So,
Thank you so much.
thank you.
Perfect. Thank you. Thanks. I think that's it for the panel. I'd really like to thank you, each one of you. I think we had quite a very insightful discussion, and you guys are the change makers. And we feel that this mobilization of whatever number that gets quoted now and then should definitely be achieved once this, all stakeholders play their role in this stitching up or crafting the charter that how should someone go about looking for financial instruments to unlock the capital. Thanks everyone. Thank you for being present here today. Thank you. So I think the panelists would be available for a while.